Okay. Why such less number today? Only 13 of you have joined. So let's start today's session. Is it okay?
Yes, sir.
Okay. Sir, just tell me whether you have got the important portions of third unit or not.
Yes, sir. Got it.
Okay. Because yesterday I had shared it with Mr. Vikas Agarwal. Okay. So today we'll go on to discuss some aspects of your fourth unit. We also divide the entire portion into two groups, which we'll discuss over the two classes today and tomorrow. One portion is related to bank, another portion is related to the insurance. In bank portion, we have the investment by banks. What is the nature of investment? What investment policy the banks basically go through? Regarding that, we'll also discuss about the SLR requirements, and also we'll have some idea on the investment management by banks. And the rest part of this unit basically focuses on the role of insurance agents, which we'll discuss tomorrow. So to start with, we'll start with the investment by banks. We have already pointed out some facts regarding the investment policy while discussing the second unit. And in that perspective, whatever we have discussed, we found that basically the portion of mobilized fund which has not been lent by the banks after keeping some reserves with them, that portion is being used for investment purposes. As you all know, banks generally accepts deposits of money from the public, thereby mobilizes the surplus funds in the economy, and then goes on to use it for some productive purposes by way of lending in the form of loans and advances. And whatever amount is left after lending, that amount is supposed to be used for investment purposes. And while discussing the investment policy, we also found that generally the banks must have to invest in such a fashion whereby they need to strike a balance between the liquidity and profitability aspect. As we have already gone through the different principles of sound lending, which is also applicable in case of principles of investment. So in that context, when we discussed about the principle of profitability and principle of liquidity, we found that both the principles are contradictory to each other. Because in principle of liquidity, we are in one way asking the bank or hoping the bank to use the investment in such a fashion whereby it will always be ready to meet the requirements of its depositors, because the bank doesn't know at what time period the depositors will come and ask for their money. So it should invest in such a fashion where it can liquidate the investment as and when possible, because it needs to meet the needs and requirements of the customers or depositors. On the other hand, while discussing about the principle of profitability, we found that it is the responsibility of the bank that the bank, while goes on to invest money, it should do it in such a fashion whereby it can ensure the maximum profit out of it. Because after all, the bank is none other than a commercial institution. And being a commercial institution, it is the basic duty of the bank that it must have to ensure the profitability of the organization in order to attract more and more customers in future times to come. So both the principles basically contradict with each other. That's why we discuss that there has to, or the bank has to strike a proper balance between the principle of liquidity and principle of profitability. Apart from there, some other principles we also discussed. So today we'll go on to find out what this investment is all about, where are the investments of banks are actually being made, and in that context, we also go on to find out one major aspect which is related to this is the SLR requirements. So I'm going to show you some slides. Please take the screenshot of it and we'll go on to discuss slide by slide. Is it visible to all of you?
Yes, sir.
Okay. So as we all know, when we talk about the term investment, it is basically meant for earning profits. As an individual, when we decide to invest some of our surplus funds, we basically invest for the purpose of getting some more return in the form of profit. Similarly, the organizations, commercial or non-commercial, whenever they want to use their surplus fund for investment purposes, the basic thing that strikes their mind is to earn more profit, because profit is associated with investment and profit is the return on investment. Whatever you are investing, you generally expect to get over and above that. And there are different investment avenues where you can go on to invest, but you need to decide which particular type of investment avenue will fetch you the expected return or will fetch you the maximum return that you are expecting for. Similar case happens with the banks also. Banks, being a commercial institution, whenever they go for investing the fund that they have mobilized in the form of deposits, the major thing that strikes in the minds of the policymakers of the banks is to earn more profit through that investment. And generally, as we have already pointed out, there is a principle of liquidity which all the banks must have to abide by while going on to invest. But it is observed that the banks normally take the help of the reserves that they keep in order to meet the liquidity requirements. Therefore, the reserves that they keep is not considered to be the investment. Rather, by using their reserve, they can meet the liquidity principle, or they can meet the needs and requirements of their depositors. Therefore, whenever they think of investment, they are actually thinking of earning maximum profit out of it. Similarly, there are certain needs which basically is considered to be the needs of the society. We call it as the credit needs, because as an individual or as an organization, we are in requirement of funds. So that credit needs of the society is also being fulfilled by the bank. And the credit needs might be in the form of short-term loan requirement, or it might be in the form of a long-term loan requirement. So after providing for loan, whatever unloaded resources or funds the banks have left with, they go on to invest it. And basically they are guided by a certain investment policy which they have framed, and they generally goes by the principles of sound lending or the principles of investment while going to invest their money. All these activities, that is meeting the liquidity requirements of their depositors, meeting the credit needs of the society, as well as getting maximum profit out of investment, is basically being conducted keeping keeping in mind the principles of lending. And here also we know that there are certain principles like principle of liquidity and principle of safety. So generally, the principle of profitability clashes with the principle of safety and principle of liquidity. So to avoid such type of classes, which generally create some certain risk on the part of the bank, it is essential to implement the policies that can create a balance between the two principles. That is principle of safety and liquidity and principle of profitability. And in that process, by striking a proper balance, the bank can go on to produce generous amount of profit for them. Now, in this context, we need to find out what are the areas in which generally investments are being made by the banking institutions. You can say that loan is also one form of investment, but we call it as the requirement, the fulfillment of the credit needs of the society. So it is also one of the forms of investment, but we are not including it under the investment policy because we are saying that after meeting the credit needs of the society, what other resources or other what left out funds are there with the bank, that left out fund of the bank will be utilized for investment purpose. Now, these are the basic areas where the investments can be. The first such investment is related to the mandatory investment. As the name suggests, it is mandated upon all the banks that they need to invest in such avenues. And mandatory investment basically is a legal compulsion on the banks. And the mandatory investment is basically in the form of investment in CRR and SLR. These are two different tools which the RBI had with it and which the RBI has imposed on all the banks. The CRR means the cash reserve ratio or cash reserve. Basically implies that portion of deposits moved by the banks which they are mandated to keep in cash for. And nowadays the CRR is hovering around 5%. So it generally 3% to 6% within this range. This CRR is being maintained. If the bank has collected 100 rupees in the form of deposits, so out of that 100 rupees, first of all, it has to keep minimum 3 to 6 rupees with the RBI in cash form. So after investing in this portion or in this avenue, 94 to 97 rupees is being available with the bank. Because 3 to 6 rupees, as I said to you, so generally it is hovering around 3 to 6%. Now it is basically being 4.5% or 4.25% is the CRR rate. So this is the portion of the total deposits which all the banks keep with RBI for in cash form, and it is a mandatory provision. Now you can ask me why this provision has been made by RBI. Because of this, the banks can be able to get financial assistance at their time of requirement from the RBI. Since they have kept CRR throughout, that is the reason why the RBI has the responsibility to provide all sorts of financial assistance to the bank at their time of requirement. So generally, because the CRR is being maintained with the RBI provides sort of financial support at time of requirement to the banks. Another avenue which is coming under this mandatory investment provision is the SLR. We call it as the statutory liquidity requirements. Statutory liquidity requirements. Statutory itself indicates it's a compulsion. It's a legal compulsion on all the banks that it needs to keep SLR. And generally, the SLR rate varies from 18% to 40%. That means that portion of the total deposits which all the banks are mandated to keep with themselves in liquid form is considered to be the statutory liquidity requirement. And it is basically varying from 18% to 40%. So depending upon the credit worthiness of the bank, depending upon the liquidity position of the bank, a bank can go for keeping 18% as SLR, another bank can go for keeping 25%, another bank can go on to keep 30% or 35% or 40%. Maximum up to 40% of the total deposits you have to keep as SLR. So there is a range here. It's not that all the banks will keep SLR of the same percentage or of the same value. That is the reason why if 100 rupees has been mobilized by the banks, out of which 3 to 6 rupees, let's suppose 5 rupees has been kept in the form of CRR, another 95 rupees is being available with the bank. So out of that 95 rupees, here we are saying 18% to 40%. Let's suppose it is 25%. So 25% means 100, total mobilized fund is 100, 25% of 100 is 25 rupees. So again from that 95 rupees, this 25 rupees will have to be kept by the banks. So this is the mandatory investment, 25 plus 5, which is in the form of CRR. These 30 rupees will have to be kept. After that, the bank is left with only 70 rupees. Out of that 70 rupees, the bank will have to lend money to meet the credit needs of the society. After that, what is being left out, that will be invested in all other avenues, which we had already discussed while discussing the investment policy. So the mandatory investment generally asks for the keeping of money in the form of reserves, and the reserves might be in the form of CRR and SLR. So for CRR, 3 to 6%, for SLR, 18 to 40% of the total deposits must have to be maintained. And in the SLR, as I said to you, the bank need to keep SLR in liquid form. Liquid form means they need to keep it in cash as well as in liquid asset form. So whatever they keep in cash form with them, that is not going to multiply their income. Because if you keep cash, idle cash, it will not be multiplied. But if you keep it in liquid asset form, liquid asset means assets which can easily be convertible into cash. So they need to keep some portion of SLR in the form of liquid assets. Because liquid assets are considered to be assets where assets generally go to generate revenue for the owner. So those liquid assets or investment on those liquid assets will definitely generate some revenue for the bank. And at the same time, because they are liquid assets by nature, because those assets are liquid by nature, they can be easily convertible into cash without loss of time and without loss of value. Therefore, the banks must have to keep this mandatory investment in the form of CRR and SLR. Then loans and advances. Here banks can invest up to 75% of own funds and up to 70% of total deposit in loans and advances, out of which, after observing the prescribed norms for the priority sector and weaker sections of the society. I have already pointed out that while discussing about the advances and loans, that 40% of the total loanable funds must have to be provided to the priority sector and weaker sections of the society. Out of which, out of that 40%, 18% is earmarked for the agricultural sector, and it is applicable to all the banking institutions. Might be it is in the public sector, or it is in the private sector, or it is in the cooperative sector. So after meeting that priority sector and weaker section norm, remaining portion can be advanced as per loan policy of the bank, keeping in view the ceiling of maximum amount of advance to a single person, similar type of business and on similar type of securities to minimize the risk involved. We have already discussed it while discussing the loan policy. So in loans and advances, whatever money is being used it is also considered to be one of the forms of investment. After that, investment with other citizen cooperative banks. So other than commercial banks, the commercial banks can also invest in some cooperative banks by purchasing securities of those cooperative banks or by investing in some other aspects of the cooperative banks whereby they can uh, have some sort of ownership in the cooperative banks also. Then investment in other banks. Other banks means there are some banks which might be deficit of money. There are some banks which might be of surplus money. So generally, but for short-term periods, that is for a period from 1 day to 14 days, there is a security by the name of call money. This security has its own market, call money market. We also call it as the interbank market. That means here the lender as well as the buyer are none other than the banking institutions. So those who have surplus money for a short period of time, they can invest their surplus amount of money for up to 14 days maximum in some other bank. So thereby they can get some return, and because it is being invested for a very short period, it can be easily convertible into cash. Then investment in non-SLR debt securities. SLR basically is in the form of statutory liquidity requirements, where we have already pointed out that it needs to invest in some liquid assets which can easily be convertible into cash. Apart from that, apart from those securities which have been included under SLR, what other securities are there which can be included as debt security? So in those debt securities, investment can be made by the banking institution as per the instructions issued by the RBI. So from time to time, this goes on to change, and it is up to the board of directors of the respective bank that they need to decide what debt securities they will go on to invest. Then the next part is investment in other institutions, corporations, and companies. As I've already pointed out that there are some NGOs where the money of the bank can be invested. There can be some social sector organizations or infrastructural sector organizations or companies where they can invest their money. So as per that policy, they're going to invest in other institutions, corporations, and companies. Then investment in share cooperative institutions. We have already pointed out that, but here there is a limit. So they can invest up to 2% of its personal funds in the share money of the cooperative institution, but it will be in accordance of the directives of the RBI. Then investment in private companies, that means equity shares. Whenever they can go on to invest in private companies shares, so they need to be cautious enough, because you know that the share market is a volatile market. Nobody can guarantee whether you will get the expected return or not, because there is the possibility of windfall gain as well as windfall loss there. So in that connection, we have already pointed out while discussing the investment policy that whenever the banks go on to invest market, it should invest in a 70:30 proportion in favor of debt securities. Because we have pointed out that some investment has to be made in government securities, some investment has to be made in approved securities, government approved securities, some investment have to be made in infrastructure and social sector, some investment have to be made in the private sector. So normally 35% of the total investable fund is being earmarked to be invested in private sector. Out of that 35%, the investment in equities and debt should be in a proportion of 30:70 in favor of debt security. So we have already pointed out that other than SLR requirements, but non-SLR debt instruments are there, the bank can go on to invest. Apart from those debt instruments, if the bank goes into invest in private companies share, then they can do it so that they can go on to get some more benefit. Then in investment in government security, it is a must because the principle of safety, the principle of liquidity, particularly the principle of safety calls for this, as the bank is dealing with public money and it is the responsibility of bank to ensure the safety of the public money. So it should go on to invest in such investment avenues where it might not get that much of return which it is expecting for, but at the same time, it might ensure that the fund is going to be safe. So if they go to invest in government securities, here the borrower is none other than the government, whether the central government or the state government. But once the government borrows money from the bank, there is very least possibility that the government will not pay back the money. The government will definitely pay back the money. So the money is supposed to be safe. That is the reason why some investment by the bank has to be made in government securities. And when as we have already discussed about the investment norms for the bank as prescribed by RBI, I had told you that 25% of the investable fund must be invested in government securities. Government securities means it's pure government securities. It is either the central government or the state governments which wants to raise funds from the market, and by issuance of certain securities, securities are there. In case of certain securities, they have treasury bills. In some terms of long-term securities, they have dated securities, long-term bonds also. So you can go on to invest in those things. Those are considered to be debt instruments actually, government debt instruments, because here the government cannot issue any equity share. It is only the private companies which can issue only the equity shares. So there also the bank can invest, as we have pointed out in the last point. But this point suggests that in government debt securities, the banks can go on to invest. And as per the prescription provided by the RBI, the banks can go on to invest up to 25% of their investable fund with the government securities. Then cash management. So except in abnormal conditions, cash balances in the bank will be kept within the fixed limit, as excess cash will affect the profitability of the bank. It is basically related to the SLR requirements also. As I pointed out that in SLR, the banks are basically mandated to keep a certain portion of their total deposits, both in cash form as well as in liquid asset form. So if they keep a larger portion in cash form, it will definitely affect the profitability of the bank, because that cash is not going to be accumulated, or that cash is not going to generate extra revenue for the bank. So it will definitely affect the profitability of the bank. So out of the experience that the banks have over the years, they know that not all the customers at the same time are coming to the bank and ask for withdrawal of money. So accordingly, they prepare themselves. They are being ready in such a fashion whereby they can meet the requirements of their customers. As a result of which, they need to manage the cash also. So they should not go on to keep more cash with them in order to meet the requirements of their depositors. Now we have already pointed out one aspect here, which is SLR, which is basically much more important, because we found that as per RBI direction, when we discussed about the mandatory investment avenue, the SLR plays an important role, because we found that 18 to 40% of the total available funds with the bank, they must have to keep in the form of SLR. So what this SLR is all about, and what are the basic SLR requirements, whereby we are saying that corresponding to SLR, or we are saying that in perspective to SLR, the banks must have to keep a certain portion both in the form of cash as well as in the form of liquid assets, because this is going to meet the liquidity requirements of the bank. This is going to meet or this is going to maintain the principle of liquidity by the banks. So generally, SLR, as I already told you, it is nothing but the statutory liquidity ratio, and it is generally being expressed in percentages form. So it is related to the percentage of the aggregate deposits that commercial banks have to invest in liquid assets. By liquid asset, we mean cash as well as liquid assets. Liquid assets means assets which can easily be convertible into cash without loss of time and value. So the time should not be lost. So without least possible of time and without loss of any value, the asset, if can be converted into cash, then those assets are being termed as liquid assets. And the RBI has specified such liquid assets which banks have to invest in to maintain their SLR. So the basic liquid assets where the banks can go on to invest. So cash is not considered to be liquid asset because cash you are keeping with yourself in cash form. So it is not a liquid asset. So either if you are investing in gold valued at a price not exceeding the current market price, or unencumbered investment in approved securities. Approved securities. Approved securities means securities those which are being approved by the government or by the central government as well as by the state government. Approved by the government means basically it refers to the securities of different departments working under the government as well as the public sector organizations where the government is having its control as well as ownership. So approved securities means those securities that are issued by the central government or any state government or other securities that are specified by the RBI from time to time. And the RBI specifies the SLR status of securities issued by the government of India and the state governments. So these are the approved securities. Basically, approved securities means if suppose in Odisha, IDCO, a corporation is there by the name of Industrial Development Corporation of Odisha. So it is coming under the Urban and Housing Development Department. So the securities being issued either in the form of bonds or in any other debt form or in any other security form. These securities are basically being approved by the Urban and Housing Development Department or Ministry of the center or of the state, and that itself indicates that the government has approved this security. You can think of the securities of public sector undertakings like IOC, Indian Oil Corporation, or you can think of NALCO, you can think of the Steel Authority of India Limited, SAIL. So securities of these organizations are considered to be approved securities. Even the securities of different banks, which the banks can raise, can use for raising short-term funds, they can also be considered as approved securities because most of the public sector banks are coming under the ownership of the government. So this is what is all about the investment, nature of investment, investment policy, and the areas of investment by the banks as well as the SLR requirements. Now the question arises, whenever such investments are being made, how these investments are being managed by the banks? Now for that, we need to go through this. So this still I have extracted from my note. I will give it to you tomorrow. You will also get it. But for now, we need to know that whenever investments are being made by the banking institutions, we have found that the banks want to invest in various securities. It invests in government securities, it invests in approved securities, it invests in social sector and infrastructure securities, it invests in private corporate securities. So many securities in which investments are being made by the banks. Therefore, it is the responsibility of the bank that the banks needs to create a portfolio of such investments. The portfolio basically includes all the securities, and the portfolio needs to be managed because individually you cannot manage. So if you have created a portfolio of your investment, then it is easier on your part, or it is easier on your wealth manager, whoever is taking care of managing your wealth, to manage your wealth by managing that portfolio. So generally, the banks go on to create an investment portfolio, and depending upon the type of securities in which they have invested, they segregate the deposit under different heads in this portfolio. So the investment portfolio of the bank is basically being divided into three groups. One is your trading book, one is your available for sale, and one is your held to maturity. So this is a provision which all the banks basically goes for, because they know that by managing the portfolio group wise, they can well manage the investments. So they have created an investment portfolio and accordingly divide it into three groups depending upon the type of securities which they have invested in. Now talking about trading book, so in trading book, generally the banks go on to include those securities which they have purchased with an intention to sell it within 90 days from the date of purchase. So if they have invested for a very short period of up to maximum 3 months, then the securities in which they have invested for 3 months only, those securities have to be included in the trading book. So the investment in such securities is for sure to be liquidated within 90 days from the date of investment. And generally, the trading opportunities arise in the security market due to two factors. One is fluctuations in interest rate, another is arbitrage opportunity. So if the banks find that, because you know that when you go on to invest in debt instruments, you are going to get interest on that investment. And interest rate gets fluctuated over time, because nowadays we have a market determined interest rate structure, which earlier we did not have. Earlier we had an administrative interest rate structure where the central government went on to decide about the interest rate. But in today's scenario, it is the market demand and supply conditions for different products of the bank which go on to decide about the interest rate. So fluctuations in interest rates basically forces the banks to go for liquidating the investment. Because if suppose they perceive that the interest rate is going to fall in future and accordingly their return is going to fall, so they can immediately sell it. So if they have invested in those securities with the intention that they will go on to liquidate those investments within 90 days, then they must have to keep it in trading book. Then next is your available for sale, where generally those securities in which the banks have invested, which have been purchased by the banks with an intention to be sold, but not within specifically 90 days. So definitely those securities will be sold. They will not be kept by the bank till the last or till the expiry of the period. Definitely they will be sold, but not necessarily within 90 days. If within 90 days the securities have to be disposed of and liquidated, then it has to be included in the trading book. But in available for sale, it basically involves or includes those securities which have been purchased by the banks with the intention to be sold, but not specifically within 90 days from the date of purchase. That means the bank will go on to observe how the return on the securities behave. If they find that for a short period of time the return might fall, but after that there is a chance that the return might go up, so they will stay back. They will not sell it immediately or instantly. So those type of securities which have been purchased with an intention to be sold definitely, but not specifically within 90 days, they will be included in the available for sale group. Then last one is your held to maturity. Particularly the government securities and approved securities are basically being kept under this category. Held to maturity, as the name suggests, it basically includes those securities which have been purchased by the banks or securities in which the banks have invested, not with an intention to be sold. So securities which have been purchased by the banks or securities where the banks have invested their money with the intention not to dispose it before the expiry of its period, then those securities will be included in the held to maturity group. So till maturity, the security will be there with the banks, because the banks know that if they go on to sell the security before the maturity period, they will be at a loss. But if they will go on to keep the security till the maturity period, definitely their return is going to be more or going to be better. That is where they can include it under the held to maturity group of the investment portfolio. So in this way, by segregating the investment portfolio into these three major categories, like trading book, available for sale, and held to maturity, the banks can go on to manage the investments properly. So this is what is all about the investment management policy of the banking institutions. Are you all clear? Are you all clear, or anybody anything to ask? Anybody anything to ask?
No, sir.
Are you all clear?
Yes, sir.
Okay, thank you. So tomorrow we'll discuss about the other aspect, which is basically related to the role of the insurance agents. After that, I will send you the 4th unit notes also. Actually, I am giving you some important portions, and I think that is enough on your part to understand what the concepts are all about. And you can write on your own also. Thank you all for your patience hearing. Tomorrow we'll meet. Thank you.
Thank you, sir.